Markets rise, markets fall. Fortunes are made and lost in the blink of an eye. But what if I told you there's a way to cut through the chaos? A way to invest that doesn't require perfect timing, just discipline. That's where dollar cost averaging, or DCA, comes in. 1. What is DCA? Dollar cost averaging, DCA, is a simple yet powerful strategy. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, whether the market is up, down, or sideways. This means you automatically buy more when prices are low and less when they're high. Over time, this smooths out volatility and reduces risk. DCA is not just a strategy, but a mindset. By committing to invest regularly, you avoid the temptation of chasing quick gains or pulling out when the market dips. It's about letting time do the work, while you stay focused on your long-term financial goals. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. 2. Why DCA works. Here's why it works. 1. Takes emotion out of investing. No panic selling when markets drop. No FOMO buying at peaks. With DCA, investing is automatic, independent of your emotional state. You avoid hesitation or overreaction to market movements. Emotions like fear and greed can sabotage an investor's strategy. DCA helps you stay grounded by removing the emotional decision-making that often leads to costly mistakes. 2. Reduces market timing risk. Since you invest consistently, you don't need to predict market tops and bottoms. Trying to time the market is difficult and often leads to missed opportunities. 3. Builds wealth over time. Markets tend to rise in the long run. By sticking with DCA, you ride the market's upward trend. Research shows most market returns come from a few key days, and by staying invested, you avoid the risk of missing them. 3. The market timing myth. But what if you could perfectly time the market? Would that beat DCA? According to Nick Maggiulli, in his article, "Even God couldn't beat dollar cost averaging," the answer is no. Even if you could time the market perfectly, the difference in returns over the long run would be small, and the psychological stress of waiting for the perfect entry point could cause you to miss valuable opportunities. The real kicker? Most investors who try to time the market end up worse off than if they just stuck with DCA. 4. Real-life strategy. DCA with dry powder. There's a middle ground, a strategy called DCA with dry powder. Instead of just passively investing, you reserve extra cash to invest when the market drops significantly. This allows you to capitalize on dips without trying to time the bottom. It's a more active approach than pure DCA, but it still gives you the benefits of consistent investing without needing perfect market timing. 5. The double down DCA strategy. This works like regular DCA, but when the market experiences a correction, say 10 to 20%, you double your investment for that period. The idea is simple. Assets are on sale during downturns. Rather than waiting for the perfect bottom, you use corrections to buy more shares at lower prices, amplifying the benefits of DCA. By having dry powder, cash set aside to take advantage of market drops, you're positioning yourself to buy more when opportunities arise, without making emotional, reactive decisions. It's a more flexible version of DCA that gives you the chance to capitalize on market downturns. 6. Where to use DCA? DCA is not just for stock. You can use it for ETFs, index funds, and even Bitcoin. Bitcoin's volatility makes it a prime candidate for this strategy, as it helps smooth out its wild price swings over time, while still positioning you for long-term growth. In a falling market, DCA allows you to lower the average cost of the asset you're buying. 7. The downside of DCA. While DCA reduces emotional stress, it's not foolproof. If you're investing in individual stocks, for example, DCA should be accompanied by careful consideration of the company's performance. It's not about blindly investing in something just because it's cheap. Always evaluate the fundamentals of the company to make sure you're not investing in a sinking ship. DCA may also lower the psychological barrier for risk-averse investors, helping them invest in more volatile assets with greater rewards. Doubling down during a correction amplifies the power of DCA. By increasing your investment when the market is on sale, you accelerate your accumulation of assets at lower prices, which can significantly increase your returns when the market recovers. While DCA reduces emotional decision-making, it's essential to remember that it doesn't guarantee profits. You still need to stay informed about your investments, especially when it comes to individual stocks or volatile assets. 8. Emotional comparison. DCA versus lump sum. Let's break down how emotions play a role in investing with a side-by-side comparison. The lump sum investor. In January, the lump sum investor is excited to invest $10,000 as the market sits at $4,000. But as the market drops over the next few months, they start to panic. By February, the market is down to $3,800. They worry, was that a mistake? By March, the market hits $3,600 and anxiety sets in. In May, with the market down 20%, the panic grows, and they might be tempted to sell everything. The DCA investor. Meanwhile, the DCA investor is unaffected by the short-term swings. They invest $1,000 each month, regardless of whether the market is up or down. When the market drops to $3,800 in February, the DCA investor sees it as an opportunity to buy at a lower price. In March, they're encouraged as the price falls further. By May, when the market has dropped 20%, they're excited. Stocks are on sale. By July, the market begins to recover, and the DCA investor is already ahead, steadily growing their portfolio. The lump sum investor, still holding on, is filled with regret, wondering if they should have bought more when prices were low. This is the power of staying disciplined. While the lump sum investor is reacting emotionally, the DCA investor remains calm and consistent. 9. Final thoughts on DCA. At the end of the day, investing isn't about making the perfect move. It's about making consistent moves. Whether you stick with traditional DCA, use dry powder for dips, or double down during corrections, the key is to stay disciplined. DCA is your ticket to steady, long-term wealth building. Over time, it minimizes emotional reactions and lets you take advantage of the market's natural upward trend without stressing about timing the market. So, are you ready to put it to work? What is your DCA plan? Let me know in the comments. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.